Thanks for jumping back to Lamb's Cryptoverse. Today we're going to discuss the FOMC meeting minutes and what it was and how the market reacted. I'll do this really fast in like 5 minutes. First of all, the Fed increased rates by 75 basis points, and this was as expected. Some were calling for as much as 150 basis point raise. I mean, if that happened, I think everything would crash. I mean, immediately. So let's talk about what happened. Speaking of crashing, I want to show you my screen here. The Dow Jones was down 1.7% and the Nasdaq was down 1.8% and S&P was also down 1.7. Looks like about 1.7 was the number. But if you look at the movement here, it was all over the place. And I think it was moving, the market indices were moving as the questions went by. And I looked at the press conference, and basically what happened, and here's the key thing I want to tell you for today is, number one, everybody expected that the Fed would raise rates. And I think almost everybody expected a 75 basis point increase in rates. So you're asking, why did the market go down? What happened was, and towards here you could see that people realized that the Fed was even more hawkish than it was the last few meetings. And you can see that in many ways. You can see that in what the Fed said, what Jerome Powell said during the press conference. You could even see that during the dot plot. And you could even see that in the decision of the committee members. Every single member seemed hawkish. You didn't see anyone disagreeing with the rate hike. And remember, there are doves in the FOMC committee, but even the doves are hawkish. So that's telling you something. And one other thing I want to talk about is this. And just like the stocks, bond rates moved a lot. They were down early in the day, early in the morning, meaning rates were down. Then when the Fed released its minutes, rates start spiking up, but then during the end of the day, rates started declining. So here's how I'm interpreting that. I'm interpreting the movement of interest rates being that the Fed's hawkish and they cause stocks to go down, and this sharp decline in stocks has raised the probability of a recession. And you could see that here with the 30-year bond, those rates went down rapidly. So that's pricing in perhaps a low probability, but it is pricing in a recession. And the same thing with the 10-year. So the place to look at during the next few weeks is the yield curve. And I said this many times. You want to see if the yield curve is starting to invert. Well, it's already inverted if you look at the 210, right? The 210 rate is 4.04%, and the 10-year rate is 3.5. But you want to look at if that spread is rising, and you want to see the 30-year. You want to see what the 30-year rate is doing. So if that 30-year rate goes down to 3.3%, so down 20 basis points from today, versus the 2-year note, that's going to be another indication that we're headed towards a recession. Now, I've been wrong about this. I kept saying that we were going to have a recession by now, and I was saying where to look, at the hard data and the soft data. Mostly the soft data. What do I mean by that? The ISM PMI data. I expected that data, that index, to decline sharply from about 52 down to the mid-40s range, even low 40s, and that hasn't happened. I think that's going to be the second indication that we're headed towards recession. The first indication is what we saw with anecdotal evidence when companies speak, and the best example recently of that, and you look at my past video, is FedEx. FedEx said we're definitely going towards a recession, and they sharply dropped their revenue and earnings guidance. They dropped their earnings guidance by something like 50%. That's unheard of. So according to FedEx, we're really going into a recession, and rapidly. Of course, some people may say that the FedEx is talking their book, that they're trying to keep their business afloat by trying to manipulate the Fed into stop lowering rates. I don't think that's the case. I mean, I think the CEO of FedEx is legitimate. He has integrity, and I think he's just saying what he sees. He's seeing a drop off in shipping volume, and you know what? We're going to find out real soon because third quarter earnings are going to come out, and what I think is going to happen is I think we're going to meet third quarter earnings, but I think CEOs are going to lower their outlook and guidance for the next quarter because they're going to start noticing that there are drops in orders, and then you're going to see issues with inventories, right? Because I think there was a lot of double and triple ordering of those inventories. And one last thing I want to show you here, and this comes reported. This is reported from Seeking Alpha, is that the Fed had their meeting and they made some comments. And this is I'm kind of repeating what I said, but I'm just going to say some highlights. Number one, they said they're going to take a forceful and rapid steps to moderate demand. And I think the key point is here is that they're going to be looking at lagged evidence. Like so, they're not going to stop lowering rates until we get a 2% inflation, and that's really lagged. That data is hard data that gets lagged by a few months. And as of 3 o'clock, the FedWatch tool said that we're looking for a 69% probability of yet another 75 basis point hike. That would be the fourth hike, by the way, of 75 basis points. I think I covered everything here. Here, this is what I said earlier. The central bank needs to see clear evidence that inflation is moving towards 2%. My friends, if the Fed waits for a 2% inflation number, it's going to be too late. So I think the Fed's going to pivot before they see this 2% inflation. And if you're interested in seeing the Fed tool, I could show it to you. It's right here. This is called the CMA FedWatch tool, and here it's shown now it's shown a 64.9% probability of a 75 basis point hike during the next Fed meeting on November 2nd of 2022. And here, where is I thought I had? Oh, here it is. I think it's. Let me just click on it. The dot plot. Here is a dot plot that shows you where the Fed committee thinks that rates are going to be, and they think that rates are going to top out about something like 4.6, 4.7%, and this is going to be the beginning of 2023. Then by 2024, they think the rates are going to go down because the economy is going to be weakening, according to them. But according to me, we're going to hit a recession really soon, within the next 6 months. So I hope that was clear to everyone that number one, the Fed's more hawkish than it's been before, and the Fed ain't stopping. They're going to keep raising rates until they break everything. And number three, there's going to be a recession. So this is going to be good. I know that sounds counterintuitive, but when the Fed pivots, or even before they pivot, gold prices, silver prices, and Bitcoin and Cathie Wood stocks, they're going to be sniffing out that there's a recession coming. And that's how you know that it's okay to re-enter and take on more risk in equities and crypto markets. And I think that's going to be happening soon. Well, thank you for listening to Lem's Cryptoverse. Don't forget to like us and subscribe to us.